Petrobras, though, 2025 saw a slight normalization compared to the record-breaking highs of previous years. Revenue? For the trailing 12 months ending late 2025, revenue is estimated at $86.40 billion, a slight dip from the $91.42 billion recorded in FY 2024. This is largely attributed to a more stabilized, yet lower, Brent crude price environment. Gross profit remains highly resilient at approximately $41.6 billion, a margin of approximately 48%. This high margin is a direct result of the company's pre-salt oil fields, which boast some of the lowest extraction costs in the world. Operating income estimated at $28.5 billion. While strong, this reflects a slight increase in exploration expenses and administrative overhead compared to 2024. Net income. The company remains highly profitable, bringing in roughly $21.2 billion TTM. This keeps their net profit margin at a 25%.
Balance sheet and cash flow. The company has shifted from a period of debt reduction to a phase of strategic reinvestment. Total assets and liquidity. As of the latest filings, total assets sit at $227.8 billion, with a cash reserve of $8.9 billion. Debt profile. Gross debt is approximately $70.7 billion. While debt has edged up slightly due to the leasing of new floating production storage and offloading units, the net debt to EBITDA ratio remains at 0.9 to 1.1x. Capital expenditure, CapEx. Under the 2026 to 2030 strategic plan, Petrobras intends to invest $109 billion, primarily into expanding pre-salt production and beginning a measured transition into low-carbon energy sectors. Over the last 5 years, 2021 to 2025, Petrobras has transitioned from a period of explosive cash growth driven by post-pandemic oil price surges to a more stable, capital-intensive phase.
Operating cash flow OCF trend. Operating cash flow represents the cash in from selling oil and gas before accounting for investments. 2022, $49.7 billion. This was a record-breaking year, driven by geopolitical tensions that pushed Brent prices above $100 per barrel. The company generated its highest-ever cash flow from operations. 2023, $43.2 billion. A slight normalization as global oil prices stabilized in the $80 per barrel range. However, production efficiencies in the pre-salt fields kept cash generation extremely high by historical standards. 2024, $38.0 billion. Continued normalization. Cash flow was impacted by slightly lower average oil prices and higher maintenance costs as the company began ramping up its next wave of production platforms. 2025, estimated $34.1 billion. Based on the trailing 12-month TTM data through Q3 2025, cash flow has leveled off. While production volumes reached record highs over 3 million BOED, lower refining margins and a softer Brent price environment have put a cap on OCF.
Free cash flow trend. Free cash flow is the cash left over after the company pays for its capital expenditures, CapEx, such as drilling and new platforms. 2022, $45.0 billion. Low investment requirements combined with massive operating cash led to historic dividend payouts. 2023, $34.7 billion, a decline from the peak. The gap between OCF and FCF began to widen as the company started increasing its investment budget for the strategic plan. 2024, $23.3 billion, a significant drop in FCF. While OCF was still strong, CapEx rose to roughly $16.6 billion as the company accelerated the construction of new FPSO units in the Buzios field. 2025, estimated somewhere between $16 to $18 billion. FCF has continued to compress. This is not due to failure, but to a deliberate strategy. Petrobras is now spending heavily, forecasted $17 to $20 billion annual CapEx to secure production for the 2030s.
Key drivers of the trends. The pre-salt efficiency. The core driver behind these strong numbers is the pre-salt layer. Petrobras can produce oil at roughly $25 per barrel, lifting plus royalty costs, allowing for positive FCF even if oil prices were to drop significantly from current levels. CapEx intensity. The 2021-2022 period was a harvest phase where the company spent little and paid out a lot. The 2024-2025 period is a planting phase where cash is being diverted back into the ground to ensure future growth. Dividend policy shifts. In 2023, the board changed the payout from 60% of FCF down to 45% of FCF. Debt thresholds. Petrobras maintains a policy where it only pays the maximum dividend if its gross debt stays below $65 billion. As debt slightly increased in 2024-2025 due to new equipment leases, the company has become more conservative with cash. Valuation. Petrobras trades at a significant geopolitical discount compared to its Western peers. Price to earnings, forward PE, currently trading at 5.3x, which is significantly lower than the industry average of roughly 12.5x. Price to book. The stock trades at 1.0x its book value, essentially suggesting the market values the company only for its current assets with little growth premium. EV/EBITDA. At 3.9x, the company is viewed as very cheap relative to its cash-generating ability. Estimated fair value. Based on a discounted cash flow model using a conservative $70 Brent price, the fair value of the ADR is estimated between $17 and $19, suggesting an upside of over 30% from its current price of $12.60. Comparing Petrobras PBR to its global peers reveals a valuation gap. While Petrobras is arguably more efficient at the drill bit, it trades at a discount due to its status as a state-owned enterprise SOE in an emerging market.
Petrobras valuation multiples compared against the U.S. majors, ExxonMobil, Chevron, and the European majors, Shell, BP, Total Energies, Equinor, as of early 2026. Price-to-earnings ratio. Petrobras, roughly 5.3x to 5.8x. This is among the lowest in the world for a company of its size. U.S. majors, ExxonMobil, Chevron, these trade at a premium ranging from 16x to 23x. Investors pay more for the perceived safety of U.S. law and private governance. European majors, Shell, BP, Total Energies, generally sit in the middle, trading between 10x and 15x. Regional peers, Ecopetrol, similar emerging market peers like Colombia's Ecopetrol trade closer to Petrobras at around 6.7x. Petrobras is effectively on sale. If it were a U.S.-based private company with the same profits, its stock price could potentially be 3 times higher. Dividend yield. Petrobras consistently have a yield between 11% and 18%, depending on the quarter's extra payouts. European majors offer respectable yields between 4% and 6%. U.S. majors offer the lowest yields, typically 2.5% to 3.5%, as they focus more on stock buybacks and capital growth.
Enterprise value to EBITDA. Petrobras, approximately 3.8x to 3.9x. Global average, the integrated oil and gas industry average is roughly 6.5x to 8.0x. U.S. majors often trade above 10x. At under 4x EBITDA, Petrobras is priced as if it were a declining business, despite the fact that its production is actually growing. Price-to-book ratio. Petrobras, roughly 1.0x. Investors are essentially paying exactly what the bricks and mortar are worth on paper. Equinor, Norway, trades at 1.4x. As a state-owned peer in a stable country, Equinor commands a higher premium than PBR. ExxonMobil, XOM, often trades near 1.9x, showing high confidence in the quality and future value of its assets. The Brazil discount. The primary reason Petrobras doesn't trade at the same multiples as Shell or Exxon is geopolitical risk. Legal protections. U.S. and European companies are protected by strong private property laws. Petrobras is 50% plus owned by the Brazilian government. Social mandates. Investors fear the Brazilian government will use Petrobras's cash to subsidize domestic gasoline prices to fight inflation instead of paying dividends. The bull case. Low-cost leader. Petrobras can break even at roughly $25 per barrel and remain profitable during market downturns. Income play. For yield-focused investors, the dividend remains one of the highest in the large-cap world. Production growth. The company is on track to reach a peak production of 3.4 million barrels of oil equivalent per day by 2028. The bear case. State intervention. As the majority shareholder, the Brazilian government often views Petrobras as a tool for social policy, which can lead to artificial fuel price caps that hurt the bottom line. Governance uncertainty. Frequent changes in leadership or shifts in the 5-year plan to satisfy political agendas can create headline risk and keep institutional investors away. Currency devaluation. Because the ADR is tied to the Brazilian real, any domestic economic instability in Brazil can cause the stock price to drop in USD terms, even if oil prices are rising.